Okay, good morning and welcome back everyone to our our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we're opening up today on a fairly, I would say, optimistic tone here from an equity markets perspective. And I want to help answer some questions that we've been getting over the past couple of days as far as, where we currently stand, because there's been quite a bit of a shift here over the past few weeks. Especially with the vaccine optimism that the markets have been trading off of, to basically counteract the extreme rise in terms of COVID cases around this country. The two have kind of counterbalanced each other a little bit. Now, last night's news that the Biden transition is going to start to happen, and we're going to start to see a peaceful transfer of power. I think that starts to shift the balance a little bit more towards the bullish side of things, especially as the number of COVID cases that are rising starts to decelerate a bit, as models are starting to show that we may see a peak in terms of cases in early December, right after the holidays, and our expectation that vaccines will likely get approved here for emergency use in early December. I think markets are starting to lean a little bit more towards the upside. So we want to take a look at some of the opportunities that we see from the broader markets. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off like we normally do with our general market update. I want to show you where we currently see some opportunities within the specific sectors and what the fixed income markets are signaling in terms of risk appetite here, which is again confirmation of the broader equity rally that we're expecting to see here over the next few weeks. I want to take a look at housing data, because this is one of the segments of the market that when we look at reopening, likely is going to suffer for a bit, but the housing data shows that it's extremely strong right now. So the opportunities that we still see in the housing data, COVID and mobility data, we want to show you some of that and what we're really looking for the markets to really start to turn around and start to find its legs, if you will, for the next leg higher here, and then share with you some of our ideas from the data that we're currently taking a look at. And at the end, looks like we should have a few minutes here to answer some questions before we wrap for the holidays. But the primary question that I want to help investors answer is really, have we overcome the hurdles that have kind of kept the equity markets in this range-bound area, for it to continue moving higher? Whether it's the rising number of COVID cases, the peaceful transfer of power, the concerns that people had around that, have we overcome all those hurdles? So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you my research, my charts, the economic data that I'm currently looking at to inform the ideas that we currently have here in the broader markets. So when we look at the S&P 500, we've been talking about this 353 level for quite some time. We've been talking about it as a resistance level prior to the breakout. We talked about this level as the level that the markets returned back to after selling off from the optimism from the vaccine multiple times, from the Pfizer vaccine, from the Moderna vaccine, both times equity markets rallying and then coming back to this level, so far holding that level as support. And with last night's news announcement that there's going to be likely a peaceful transfer of power, I think this starts to shift the balance a little bit towards that bullish side. So holding the support level, continuing to see a little bit more strength, from my perspective, is constructive. As you can see, money flow has been improving a little bit here over the past couple of weeks. And this is the type of movement that we're looking for continuation higher. Now, when we look at the Nasdaq 100 index, it is still weaker, but as you can see, has not weakened over the past couple of weeks. It is not as strong as the S&P 500 and still below these major resistance levels. So we're expecting to see over the next few days, as equity markets can rally, whether technology can join this rally. It's really one segment of the market that is lagging behind and may actually lag behind for quite some time here. I do expect technology to eventually come back to life as this equity market starts to pick up some steam here, because consumer discretionary does lead some of these tech stocks higher. So we want to pay attention to that. But the main point here is the fact that we still have small caps leading this market higher is part of why we maintain a fairly bullish view here for equities. The fact that equities hasn't really moved higher here broadly from a big cap perspective over the past few months, but small caps starting to lead this market higher is what we are looking for a continuation higher here from the equity markets. When you have the small cap names rallying, this is showing that there's broad participation in this equity rally. It's not just a few tech names that are dragging the markets higher. And we're seeing this from a small caps perspective. We're also seeing this from the equal weight S&P 500 index perspective. After breaking out on that Pfizer news, after breaking out on that Moderna news, testing this 122, 123 resistance level as a potential as a resistance level, I think we now have the potential for RSP to break out above that to new all-time highs, and that's going to bring the broader markets along with it. So overall, across the board, seeing fairly healthy markets from a broad participation perspective. When we look at when we look at the individual sectors, we see a fair amount of healthy sector rotation. These are the things that we look for in the lifeblood of a broader equity market rally. The one thing that I do want to point out that is very, very important for options traders is this shift in terms of the volatility regimes. We can think of prior to the coronavirus as one volatility regime, and since the coronavirus as a second volatility regime. From my perspective, this is our original volatility regime. Here is our second volatility regime, and I would argue that we've now entered back into a third volatility regime. The third volatility regime looking very similar to what we had here in prior to the pandemic. So, post the pandemic, what we had is very elevated implied volatility, where the high end was in the 40s or so, the low end were in the low 20s. But prior to this, the low end was in the low teens and the high end was in the low 20s or so. So my argument here is that despite the fact that we are relatively low compared to the post-pandemic levels, what we're likely going to do is now revisit again our pre-pandemic levels. So even though we're relatively high, my expectation is that we're actually going to continue to resume to the lower side. So for options, traders, when we look at 22, we say that, oh, this is relatively low compared to what we've seen here over the past couple of months. But I would argue that we're now going to enter a lower volatility regime. And that means that even though we're in the low 20s, that it's likely going to now shift back to the high teens. So volatility is going to be lower than what we have seen over the past few weeks or the past few months, but is still likely going to favor option selling strategies here in the short run here, because with VIX at 22, it's still fairly elevated compared to what we saw here prior to the pandemic, which gets into the low teens. So that is the major shift that I think is important for options traders to understand, because as you're thinking about option strategies and which ones to use, those are important decisions for you to make. Now, when we look at gold, we've been talking about gold for quite some time here, but gold finally yesterday broke below a major support level around 175. From my perspective, this really puts this any ability for gold to rally substantially in the long run at risk here. And I think it's more likely that we're going to see a continuation here lower here for gold. So this applies for gold or silver. But what's interesting here is what we've seen a complete decoupling between gold and Bitcoin. Bitcoin is continuing to rally. Bitcoin is now at the prior $19,000 high. And what's interesting here about this, we talked about Bitcoin when it broke out above 13,000, and I was expecting a move back up to 20,000 as for some of you that joined me a few weeks ago. I think it was only 2.5, 3 weeks ago when I talked about this. I certainly did not expect Bitcoin to reach 20,000 in this short amount of time, but it did. And what's important here from my perspective is the fact that we are back to its $20,000 high. And what's interesting is that this movement here to the upside was not on particularly strong volume. So what this speaks to is really just a bit of lack of supply. There wasn't a lot of retail participation in this particular move. It was actually quite a bit of institutional buying. So the fact that institutionals are starting to get into this play means that if we do get a breakout here above 20,000, there could be substantial upside here for something like Bitcoin. Obviously, we can't trade Bitcoin options, but for those of you that trade futures or just buy Bitcoin on one of the exchanges, the fact that we're reaching 20,000 and we're about to get a breakout here to the upside is certainly constructive. We may get a pullback here from that 20,000 before that continues to move higher, but looking for that breakout here on Bitcoin, from my perspective, does look fairly constructive. When we look at the 10-year yield, 10-year continues to be in this uptrend here. Taking a little bit of a pause here, but maintaining this uptrend. So our expectation still is by the end of the year, closer to that 100 basis point level here on the 10-year yield. And this has ramifications for financials. So when we look at XLF, we've seen a continuation higher here for XLF on the breakout here. I likely will see XLF continue moving higher. From my perspective, I do like playing this move here to the upside in terms of banks using KRE rather than XLF, because KRE more sensitive or highly correlated to that 10-year, versus XLF has some big names in there that are not interest rate sensitive, like Berkshire Hathaway, American Express, S&P Global. Those are the types of names that mix up the picture here for XLF or muddy the waters a little. So if you want a more direct exposure to that move here to the upside in rates, I think KRE, the regional banks ETF, may be a better way to play that. When we look at the fixed income side, we see clear delineation between fixed income investors that are seeking high yield. We're still continuing to see flow into high yield. This high yield broke out above that $85 level recently and has continued moving higher here, versus TLT or any of the treasury ETFs that have seen substantial outflows here over the past couple of weeks. So this shift in flow away from treasuries into higher yield speaks to the risk appetite that fixed income investors also have. And this is further support of the equity market rally that we're going to likely see after the holidays and continue after the holidays. Now, the question is really, which sectors do you focus your attention on that particular market rally? And that is really what I think is important here for equity investors, is to focus on not just the equity rally, but which sectors to specifically focus on, because everything that, whether we're looking at fixed income, whether we're looking at market breadth, this is all supportive of this continuation higher. But we also at the same time see this healthy market sector rotation. So looking at financials, looking at industrials, those are the names that we want to pay attention to. And when we look at energy, so one of the things that I do want to point out here is we've been looking at crude for quite some time. Crude has been largely range bound between this $42 level and the $36 level, but we finally got a breakout here to the upside this week. Now it's still about to contend with this $44 resistance level. If you're following Brent, that correlates to about $46 resistance level, but there's a lot of resistance here to the upside into that $50 level here for WTI. So this, from my perspective, means that crude has a little bit more upside potential, but that upside is fairly limited. And from my perspective, the move that we have seen in crude does not quite correlate with the moves that we've seen from XLE that have had back-to-back weeks of double-digit gains from a percentage perspective on the Pfizer news, on the Moderna news, on the recent AstraZeneca and the peaceful transfer of power news. We've seen big moves here to the upside on energy, and from my perspective, this continues to be too far, too fast from my perspective. Now, this is, I will say, a difficult place right now to short, because any further vaccine news, any further reopening, good optimism on that front is likely going to continue to push this higher here in the short run. So be very careful about shorting this. I do think that if you're going to short this, you want to watch the weekly chart rather than the daily chart here. You want to see more extreme moves to the upside, perhaps all the way into this $43, $42 gap fill level here before you can continue moving lower here, because long run, we're still fairly bearish here for XLE, because that long-term underperformance is still intact here. There has been no signs that this trend has reversed. Now, if XLE gets back above 47, 48, then we can certainly say XLE's downtrend has started to reverse and maybe continuing to move higher here. But until that happens, I think it's difficult to call that. And on the flip side, one of the strongest sectors that we continue to see outperform here in the broader markets is industrials. Industrials leading the markets higher here. Looks like today it's likely going to break out to that all-time high here. We've been talking about the strength of industrials compared to materials last week when we reviewed the overall sectors. So industrials certainly one of the top picks in terms of sector rotation as we see a continuation higher. You know, we do have exposure in XLI or industrials through FCX, Freeport, McMoran in our daily plays, but this is one of the sectors that we certainly want to pay attention to. Now, one segment of the market that we haven't really talked a whole lot about over the past couple of months is really housing. Housing has kind of died down a little in terms of relative strength, but when we look at the housing data, this still continues to point us towards a segment of the market that will likely be extremely constructive all the way through 2021. We still continue to see existing sales be extremely strong at about a little over 6.5 million existing sales. Single family housing starts at 950 million, extremely strong here to the upside. And at the same time, inventory at multi-decade lows. This speaks to the shortage that we currently see here in the housing markets and the huge demand there is for the housing markets and the inventory gap that has started to form as a result of this strong demand, which is why we really like some of the home builders. And I want to show you some of the charts that we're currently paying attention to as these home builders have consolidated here over the past couple of months. And now they are potentially starting to break out here to the upside. On the COVID data front, one of the things that we started to see over the past few days, now this is still a slightly evolving trend here. We'll see if this is likely going to happen, but some of the models are starting to show a peak here in very early December. But we certainly have seen that the rate of increase in terms of cases have started to decelerate. This has happened for the past week or so. So that is fairly strong. The fact that the number of cases are growing at a slower pace speaks to likely what we might see as a peak here in early December, which correlates also around the same time that we expect to see the vaccine approval for emergency use. So this is likely the optimism that the equity markets are forward looking into, as mobility data has continued to decline here over the past couple of months here, but that decline is relatively small considering the huge number of rise in cases that we have had. I do expect that once you start to see this peak and start moving to the downside, that mobility data would also start to increase here to the upside. Once that happens, that would clear all hurdles, in my opinion, for a continuation higher here from an equities perspective. But by the time that happens, equity markets could already be substantially higher here. So we are trying to be a little bit ahead of that curve and knowing that this is going to likely happen here in early December and looking a bit ahead, 2 to 3 weeks ahead, and trying to plan for that accordingly. So on the home construction front, when we look at ITB, the Home Construction ETF, largely range-bound for quite some time, strong off the March lows, spent about a month and a half consolidating, strong move to the upside again, then spent the past couple of months consolidating between this $58 level, $52 level, and we're about to break out here to the upside. It still has resistance here at the $60 level. If we can break above that 60, that would really open this up substantially here for more upside. But money flow has been improving here over the past couple of weeks. Momentum has again shifted more towards the upside, the bullish side here. So a potential breakout here for ITB. Now you can also use some of the major players like DR Horton, Lennar, Pulte Group. These are all, in my opinion, suitable plays here for a continuation higher. DR Horton, in my opinion, a little stronger than those other two. When we look at jets, this is the global airlines ETF revisiting the $22 level. We talked about this when it originally reached that $22 level on that Pfizer news. I said, be careful, you're likely going to see a fade of that. That's exactly what we saw. Moderna news, same thing. Pop up to the upside, faded a little bit. Now we're reaching that $22 level again. So now I think is the opportunity to play for breakouts here on the Jets ETF. Now we have played out, we decided to use Southwest Airlines as the way to go about doing so, because Southwest Airlines, as I've said over the past couple of weeks, one of the few airlines that is focused purely on domestic and leisure travel, which is by far going to recover faster than any of the international travel. We will look at flights by aircraft type, when we look at the narrow bodies, the 737s, the Airbus A320s, those are roughly back to pre-pandemic levels. Some of them are in the, both Airbus 737, I'm sorry, the Boeing 737 and the Airbus A320s are about 70, 75, 80%, compared to the same time last year here. But if you look at the wide body stuff, the Dreamliner, the A350s, the 777s, these are still about 30 to 40% below the same time here last year. So narrow body fleets like Southwest Airlines that operates only 737s, these are the ones that are likely going to recover significantly faster than Delta, United, and American Airlines. Southwest Airlines has substantially more cash, they have very little debt, and they are currently taking this opportunity to expand their network of flights, rather than the legacy airlines are currently pulling back, trying to save cash, trying to make sure that they can survive. Southwest Airlines doing the exact opposite. So we're looking for reopening over the next couple of years. We certainly expect Southwest Airlines to be a strong contender compared to the legacy airlines. So that's why, that's our top pick for a breakout here on that Jets ETF. When we look at Disney, what's interesting about Disney here is that it really is both a reopening and a lockdown play here. So just, we currently still have a high number of COVID cases. It's still growing here to the upside, even though we do expect over the next few weeks that it's going to start to peak and start to decelerate or start to decline. But Disney, on both sides, you have the theme park that is likely going to benefit from a reopening trade. You have the streaming side that is going to continue to be strong during the time, because COVID cases are still going to stay elevated for quite some time here. It's going to take quite a bit of time for vaccines to disseminate through the whole general population here. So Disney, actually one of the plays here, about to reach these recent all-time highs here. So Disney potential breakout here to the upside as more optimism both on the streaming and the reopening side for the theme parks play out here. One other segment of the market that I want to pay attention to on the reopening side is Lyft. Now, Lyft is just getting back to its $42, $41 level, which has been a major support or resistance level pretty much since 2019. And we're just about reaching that $41 level here. So potential breakout here on Lyft, from my perspective, has some opportunity here to the upside. When we look at Lyft versus Uber, what I like about Lyft is the fact that it's solely focused on rideshare. It doesn't have other businesses like Uber Eats, which certainly presents a longer term opportunity for Uber. But in the short run, there are some operational challenges. They're spending a lot of money to compete and gain market share on that particular business. That is not a profitable business, and largely has not been a profitable business for any operator in this particular space for the past decade. So, food delivery, whether that will ever become a profitable business is really hard to say. Lyft focused on rideshare, focused on mobility. This is the type of company that I think is going to outperform, in my opinion, in the short run versus Uber. So those are the plays and opportunities that we currently see in the broader market rally, a broader market. Like I said, overall markets look fairly constructive here. Looking out in the next 2 to 3 weeks, I think there's a lot of optimism around the decline in COVID cases, the vaccine, the peaceful transfer of power certainly overcomes all of those hurdles. And I think especially going to tomorrow and Friday, which is going to be a thin trading market. So what you could see is a bit of a melt up, some light buying, but because there's thin liquidity causes the markets to actually make exaggerated moves to the upside both tomorrow and Friday. So that could potentially happen. So if you're trading tomorrow, be careful about that. Just be understanding that the markets are going to be relatively thin, but going forward past Thanksgiving, things look fairly constructive. Just make sure you understand where to focus that attention on. So with that, I want to thank everyone for taking the time out here this morning. I hope this is useful in helping you understand where we currently sit in the broader markets, how you want to position for it, and how you want to look for opportunities. So with that, I want to thank our members for supporting us and allowing us to continue doing this every single week. So at this point, what I'll do is I'll open this up for Q&A. If anyone has some questions, please type them into the chat window. And if you want to consider supporting us, you can sign up for a membership. It's just $75 a month or $500 a year at trade.optionsplay.com/member. And if you are brand new to OptionsPlay, if you don't have a free trial, you can sign up for one at optionsplay.com to have access to the the platform and the tools that we have for investors. So with that, let's take a look at some of the questions here. BBY is pulled back after earnings. Is this a good opportunity to buy? Best Buy certainly is one of the strong players in my opinion in the longer retail play here. They're fairly I would say well positioned within the consumer electronics space, which we expect to continue to be strong in 2021. So I certainly think a pullback here, into this 116 level, as long as it doesn't get below these levels here around 111, 112, I think could be a potential long-term buying opportunity. Would you sell credit spreads here on Lyft or KRE? From my perspective, I think the upside here over the next few weeks can be fairly large here. So my preference is to buy call spreads rather than selling put spreads. On LUV, we were selling put spreads here, but we're opening up substantially higher here. I'm sorry, on LUV, we're buying call spreads here because we do see some substantial upside here. So that's why we are using call spreads, because we do think over the next couple of weeks, you could see some extreme moves here to the upside. Intel on Intel trade. So Intel, I think it's time to just cut this trade. It's not moving south as we had expected, or it's just trading sideways here. So I don't expect Intel to continue to move substantially here to the downside. So this, I think, is one to start cutting. I think we're going to start taking profits here on Clorox. We're probably going to start taking profits here on MasterCard as well. Those are the plays that we're currently paying attention to. Tesla, we're getting a lot of questions on the electrical vehicles. So I just want to comment on this. Tesla breaking out above this $500 level is constructive, I think, for Tesla to continue moving higher. But I do want to just note here on those of you that are trading NIO or XPEV or any of the Chinese electric vehicle names here, be very careful. That's the only thing I can tell you. Ask yourself, am I, a lot of people that are playing this are saying that they're on the electrical vehicle. They're trading NIO because they like electrical vehicles, but when you're trading 1 week options on NIO, you're not trading electrical vehicles. You're just trading a stock that has very high momentum. So be very careful about that. Be conscious of that. If you want to trade these types of high volatility names using short-term options, buying out of the money call options, out of the money put options, there's only one thing that you have to do, and that is being extremely disciplined. Extremely disciplined on when you cut your losses, extremely disciplined on when you take your profits. If you are a long-term investor in electrical vehicles, that's a completely different story. I think that if your time horizon is looking out the next at least 2 to 5 years, these are perfect stocks to put into your portfolio. NIO, I would diversify across 2 big players, Tesla and GM, and 2 small players like NIO or XPEV or any of the other small cap names that you particularly may like. I think that if you want to play the electrical vehicle theme, put a couple of big cap names like Tesla and GM in your portfolio, put a couple of small cap names in your portfolio, have 4 or 5 stocks. That would make up a good portfolio for the next 2 to 5 years. If you're playing short-term call options on this, it doesn't really matter the fact that it's an electrical vehicle. Don't kid yourself in saying that I'm playing the electrical vehicle play, but be disciplined, because I have seen fortunes made and lost overnight trading these types of plays. We saw it in the early pandemic days, people trading Apple calls, making tons of money on that move to the upside, and then losing all of that money, a few days later on the extreme moves to the downside. That's what you're going to get when you're playing names here like NIO. Thoughts on AMD? AMD, certainly one of the ones that we like here. AMD, NVIDIA, both AMD and NVIDIA are ones that we like here. But in the short run, I think that these are fully valued. I talked about this on CNBC. You have the extreme, I would say demand for their from a consumer electronics space perspective on their chips, but you've seen a substantial decline in corporate demand, especially on the enterprise side. Cloud computing expansions have decelerated substantially over the past couple of months as cloud companies have slowed down their growth in terms of expansion on cloud computing. So that largely has kind of offset each other. I think that if you want to look at the semiconductor space, look in more of the consumer space, anything that's to do with the automobile automation, consumer chips, 5G chips, those are the ones that I think have more opportunity in the short run. But long run, AMD and NVIDIA, I both like, but it really depends on what your time horizon here. MGM, one of the things is that, the casino and the gaming stocks will likely to continue to do okay here to the upside. It has broken out here above those highs, and I do think that you get a continuation higher here. Gaming, has picked up a little bit here in China, but hasn't been particularly strong. So that's one that I'm not very, very strong on per se. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to where we currently stand. A lot of great feedback on Friday's member only rapid fire session here. So we're going to do another one here on December 11th. We're going to ask for you guys to submit some symbols ahead of time so I can organize that a little better and make sure that we cover more of the symbols that you guys all requested. So really looking forward to doing that again here on December 11th for everyone who is a member. So thank you so much again for all of our members for supporting us and allowing us to continue doing this. I hope that for those of you that are currently on a free trial, you consider supporting us and allowing us to continue doing this, and for you to get invites to our member only sessions where we just take the symbols that you want to take a look at. I research them ahead of time and give you a sense for my thoughts on the symbols that you want to pay attention to. So with that, thank you so much. I hope everyone has a happy holiday. This will be our last session before next week. So I hope everyone has a happy Thanksgiving, and I'll see you guys here next Tuesday. Have a great trading day.